My name is Michael Duke, and on this channel, I talk about a lot of things, but notably, I analyze stocks that I find interesting and compelling. And if that type of content interests you, then please consider subscribing to my channel and liking this video. Also, please feel free to weigh in with your feedback, comments, and any recommendations of things you'd like me to check out. I still have a few that viewers have submitted that I need to get to. However, today I really want to deep dive into this company. It's called Nutrien Ltd, ticker NTR. I find this company very, very interesting for many reasons, and I really wanted to feature it on the channel today. So, without further ado, let's get into the video. And as always, I'll be doing a overview of the company. I will discuss the investment thesis, why it might or might not be a compelling investment for your portfolio. I'll discuss some of the narratives and sentiment driving the stock price, at least that I can perceive. I'll also be doing an analysis of the financials, the valuation. We'll take a look at the dividend metrics. We'll also take a look at some of the risks involved with investing in this company, as well as giving it a grade, whether it's a buy, sell, or a hold, according to me. We will discuss risk parity with this investment today. We don't always do that, but we will today. And then, as always, we will conclude our video by doing some basic technical analysis of the chart. So let's get into it. So Nutrien is in the materials sector. Specifically, the company is operating through four segments: retail, potash, nitrogen, and phosphate. So this company is a fertilizer producer that also has a retail arm that they sell their products through. Potash, nitrogen, and phosphate are all different types of fertilizer. So right off the bat, I think it's worth noting that because this company is essentially a commodity producer, fertilizers are somewhat commoditized. They fluctuate in price on an openly traded market. Because this is a producer of those type of products, it is somewhat exposed to those price fluctuations. So this company, I think, just common sense wise, it in theory should not be and cannot be a wide moat stock. Any sort of moat that they might derive economically from their company structure or pricing or integration should come from their production process to create the inputs. If they're able to produce them cheaper than the average on the market, then they may be able to create a narrow moat. So right off the bat, the fact that it's not a wide moat stock may turn off some investors. However, and I'll dive into why, I do believe that this is worth a look for certain types of strategies. The company is headquartered in Canada, which is also relevant, and I'll discuss why later. But the company is a mid-cap, $24 billion market cap. And they are 26,000 employees, a leading global provider of crop inputs and services, operating a world-class network of production, distribution, and agricultural retail facilities. They produce and distribute about 26 million tons of potash, nitrogen, and phosphate products for global agricultural, industrial, and feed customers. The retail arm services over 500,000 grower accounts worldwide. So definitely a large player in this industry. So I'm going to discuss the thesis of why I think this is interesting, but the best way for me to demonstrate it just by taking a look at the stock chart. This company has only been trading under this ticker since 2017. And I believe that was due to a merger. Nutrien, the world's largest crop nutrient company by capacity, was formed in early 2018 as a result of the merger between Potash Corp of Saskatchewan and Agrium. It's also the largest agricultural retailer in North America and Australia, with a growing presence in Brazil. So notice this stock chart doesn't look very good. Really just traded flat for a few years during the COVID crash, went all the way down to the high 20s before really spiking here, and has since just downtrended. And really, it does appear in the last 6 months or so to kind of consolidating around this, just sub $50 base here. So why is that interesting? Well, let's again take a look at this chart visually. I'm going to pull up another chart here. This is the 12-month percentage change in the CPI by the US Bureau of Labor Statistics. So again, let's go back to January 2018. CPI is relatively flat, crashes in COVID, spikes here, tails off. That chart looks a lot like this chart. I haven't actually calculated the correlation of that CPI statistic to the stock price here. The stock price of this company and the CPI appear to be strongly correlated. I think it is fair to say that crop input producers, at least in the last wave of inflation, served as an inflation hedge. And that's really the main thesis underpinning an investment. Now, each wave of inflation, in theory, can be caused by many things. The inflation that we saw late 2021 over 2022, that was a supply side driven inflation event. That was a supply side inflation event. You had areas of the economy shut down, supply chains were disrupted due to the shutdown, less things were moving around very temporarily, but people still had income, whether it was from government stimulus across the world or they kept their job, they kept their income, they were working from home, they started ordering things online, buying things. There was money sloshing around and less places for it to go. That caused supply shocks, and that drove inflation. And if you're like me and you believe inflation is a monetary phenomenon, there's that whole element of it too. The money supply in most countries around the world was increased due to quantitative easing and other factors, and that drove some of that stimulus into the economy, more money flowing around, chasing fewer goods, creating inflation. So I'm not going to go into what creates inflation as much, even though it is relevant for an investment in this, and it's worth considering how the next wave of inflation and theorizing what might cause that before considering investing in a company like this. However, again, I just want to draw very simply and plainly the correlation between this graph here and the stock price. Furthering that thesis, let's take a look at the price performance over 5 years. So what do you notice here? Well, during the time when inflation was causing the S&P 500 to sell off, this stock also happened to be booming. Now, I think it's worth noting, really, since late 2021, early 2022, this stock has essentially been shown a fair amount of inverse correlation to the S&P 500. So that's really the thesis here with this stock. Past performance is not indicative of future performance. However, if you had been invested in this stock the whole time, along with a lot of exposure to more cyclical stocks, other stocks in the S&P 500, tech stocks, whatnot, and you had a healthy allocation to this company, you likely outperformed during this bear market here. So that is what's interesting. I think, again, it's pretty easy to see the market looks at this stock as an inflation hedge primarily, along with paying a relatively safe and growing dividend. Um, this stock is primarily, I think, in the eyes of the market, an inflation hedge. And therefore, when inflation is coming down, um, in theory, it makes sense that it is sold off. So, um, does the company have a moat? Well, let's take a look at the Morningstar report. And I will be referencing the report quite a bit because they have a lot of good insight in here by several of their analysts here. Um, First, I'm going to go to the analysis of the moat written by this gentleman here, Seth Goldstein, strategist at Morningstar. So they award a narrow economic moat to Nutrien due to its cost advantage in potash and nitrogen. We expect potash to account for a little over 1/3 of mid-cycle profits. Nutrien's potash mines are located in Canada and sit on the low end of the global cost curve due to favorable geology that results in a lower mining and processing cost versus its peers. Nutrien's low-cost potash operation came from legacy Potash Corp, which again, that's one of our merger constituents there. So Potash Corp invested in a new low-cost potash mine before the merger. The potash assets from the legacy portfolio were firmly in the lowest quartile of the global potash cost curve. In other words, they are in terms of cost efficiency, the top 25% of all potash producers worldwide, given that they are the largest by capacity company in the world. That is significant. Seth elaborates further by saying Nutrien's nitrogen business, which we expect to account for just under 20% of mid-cycle profits, also benefits from a low-cost position. And nitrogen feedstock cost is the most important determinant of a producer's cost position. Nitrogen is generally made from natural gas, with Chinese producers also using coal. Globally, the lowest cost natural gas is produced in North America and the Middle East. In recent years, Europe has seen higher costs, relying on Russian natural gas. That's been disrupted with the war in Ukraine. European producers are exposed to higher prices, and as such, those prices are currently elevated above the North American natural gas prices. Seth and his colleagues at Morningstar believe that, quote, this steepening of the cost curve will benefit low-cost North American producers. For Nutrien, 75% of the company's nitrogen is produced using low-cost North American natural gas. So that is the thesis underpinning a narrow economic moat, which I would assume and think is really the probably best moat, highest, most optimized moat size or scope that a agricultural commoditized input producer can derive. And you see also Morningstar believes that the stock is pretty undervalued here and has been for most of its trading history, giving it a 4 out of 5 star ranking. So that's the thesis and the narrative around this stock. It's seen as an inflation hedge. It has a narrow economic moat being derived from its cost structure, its ownership of production assets that benefit from very strong locational advantages with either how they're extracting the materials to produce their products or just the price of the commodities that are going in. So very interesting, very sound. So you can probably see here that if this stock was the biggest holding in your portfolio, you might not do so. You certainly would not have done very well over the last 5 years. However, a modest allocation to it would have helped the risk adjusted returns of your portfolio during this bear phase. Now, that doesn't necessarily mean that it will outperform in a bear market. However, given that this bear market was inflation shock driven, it just happened to do so. I find that very interesting. So let's take a look at the financials. I like to take a look at the income statement. Let's take a look at the income statement on an annualized basis. Again, if you remember, 2018 is when the merger occurred. So let's just only focus from 2018 to the trailing 12 here. We see revenue has gone from about 19 billion up to a peak of 28 billion. That's about 50%, and has dipped somewhat by about 10% down to 25.5 billion. Um, Gross profit from 5.4 billion up to a peak of 8.5 billion. That's roughly 25 to 30%, just doing the math in my head, to the peak, um, down again, dipping about 10%. But what do we notice about revenues and gross profits? Not only are they volatile, but gross margins are inconsistent, which is what I would expect from a company whose revenue streams are more dependent and susceptible, exposed to commodity price fluctuations. And operating income, we see, is about the same story. In fact, operating income from the time of the merger to now up about 25%, 30%, down from a peak of about four, almost, that's what, 80%, 75, 80% growth to the peak. So when you have these big inflation driven shock events that really drove up the prices of fertilizers, this company benefited tremendously and was able to expand their gross profit margins and especially their operating income margins. However, when prices are on the way down, they have to get a little bit more competitive with selling their products. So let's also talk about the fact that if you remove the price fluctuations, that fertilizers are a critical input and component of global food security. So they're a necessary product, and they will always be in demand. However, the level and relative demand from period to period may be volatile and wildly inconsistent. I think that these financials demonstrate that. So I think what's important when investing in a company like this is that they are very cyclical. What's important is that their shareholder distribution policy is conservative. In other words, when they're making a bunch of profits due to a very favorable environment like they were in the last few years, that maybe they do increase their dividends somewhat, but they don't just expand their shareholder distribution so much. They hold on to some of that cash. They don't distribute all of it. And it's great, I think, for a company like this, for it to be investable, for it to demonstrate a very conservative uh, shareholder allocation strategy. So let's review that. Here we see um, that they've actually really bought down a lot of their shares over the years. It almost appears that the biggest change, 840 million to 625 million shares outstanding, that coincided with the merger. We see here revenue per share 51.67 in the trailing 12. The revenue per share, that implies their price to sales ratio is less than one. So it's looks like a value from that standpoint. Let's look at the dividend per share, notably from, again, 2018 forward. We see here that their dividend per share has increased from $1.63 to $2.15. That's, I don't know, 30% roughly in that time frame. Their payout ratio, very volatile, again, indicating that their sales and their cash flows are very volatile relative to maybe other stocks on the market. So in the trailing 12, they paid out over 100% of their profits, whereas in 2022, when things were going crazy, only 13%. So that indicates positivity to me. And to kind of further analyze that, let's take a look at their balance sheet. So cash and equivalents, most recent report, 520 million, versus long-term debt of 9.3 billion. We see here that it looks like both entities, when merged, brought a lot of debt to the table, and that debt has kind of been up and down in the last few years. It's ballooned, it's gotten paid down, it's gone up. Really, debt has trended up over the last 5 years or so. So That's not great. However, they have retained a lot of earnings, again, indicative of when they did start making a ton of cash quickly, more than they maybe expected to, that they retained a lot in the business and did not just drastically increase their dividends. So the income statement, it looks as I would expect for a volatile cyclical stock like this that has a at best narrow economic moat. It does appear that their capital allocation strategy is what I want to see from a company like this. If a company like this is paying a dividend, I really do not want them to distribute these huge dividends when they're making these big profits, because I want them to hold on to that cash when they inevitably reach the down cycle, which is, effectively what they've done. They have more cash on their balance sheet than they did otherwise, again, pre-merger, so maybe that's not as relevant. To kind of further illustrate that point, I want to again refer to the Morningstar report. So they describe capital allocation as exemplary. So let's just take a look at what they say about that. We assign an exemplary capital allocation rating to Nutrien based on our framework that assesses the balance sheet, yada, yada, yada. They rate the balance sheet as sound. As I referred to earlier, they also reiterate Nutrien's revenue is subject to high cyclicality. However, with a healthy balance sheet, manageable debt maturities, Nutrien is not in danger of being unable to meet its financial obligations. They view the investments management has made as exceptional. We're in favor of the decision to invest in cost reductions and capacity expansions in the low-cost potash and nitrogen operations, as these businesses underpin our narrow moat rating. This is really what I wanted to discuss here and what I was talking about while reviewing the financials. We see shareholder distributions as appropriate. The dividend can generally be paid using free cash flow generated by the more stable retail business. As a result, Nutrien should be able to maintain the dividend even when fertilizer prices are at cyclically low levels. So that's the important part. If you're investing primarily for dividends, and you want to see consistent and stable dividend growth over time out of a company like this, then it is paramount and required that the company is able to maintain their dividend payout and dividend growth in periods of low prices, which, again, let's take a look at potash prices over time. Potash prices. Let's take a look at this chart here. Again, we see here, I can't go to 10 years because I do not pay for Y charts, but we see here just how much potash prices went up. They went up like 500%. This is per metric ton here, dollars per ton, 200 to 1200. And we're still above COVID lows, it appears here, but fair enough to say that the commodity prices are at cyclical lows. So let's take a look then at the dividend. Current yield, forward focused yield, 4.43%. That's very strong on a 60% payout ratio, of which it has grown by 4.32%. So the chowder number is 4.43 plus, so that's 8.75%. That is slightly lower than the weighted average of my portfolio. However, it is close. The weighted average chowder number is 9.1-ish of my portfolio. This is right around there. Let's take a look at the dividend yield. It is not the highest it has ever been. However, it's pretty close for the majority of its trading history. It has not been above a 4% yield. It happens to be there now. And when it peaked, it was slightly below 2%. So the dividend yield is very strong. Here's what's interesting, and really what the Morningstar analyst was referring to, free cash flow yield. It's almost a double-digit free cash flow yield, both trailing and estimated forward-looking, 9.5-ish%. That's very strong compared to a lot of stocks in the market today. So that's great. In other words, their dividend yield being 4.5, 4.4%, their free cash flow yield 9.5. the dividend is well covered by free cash flow yield and at cyclical low prices. So, in other words, shareholders should feel very comfortable that they will continue to receive the very strong dividend and very modest dividend growth, even in a low price environment. And if prices were to significantly increase due to another round of supply side inflation, I won't speculate on if that's the case or not, but if that were the case, then they conceivably would be able to retain more earnings, invest more in their business operations, the expanding retail locations, so on and so forth. So I think that's very interesting. In other words, you can enter this stock with the main purpose being to hedge against inflation in your portfolio and collect a very strong growing dividend along the way. Seeking Alpha does give the safety of the dividend a B minus, and kind of a mixed bag here of grades, but I would consider this dividend to be safe. Let's take a look at the dividend history here. So the first dividend paid 40 cents a share to 54 cents a share. So that's about it's a shade under 30%. Pretty modest growth. You see here the largest increase in growth was when they did see more economic profits. So I think that, again, mirroring what Morningstar is saying, I think that their dividend yield, their dividend growth is very appropriate for the business that they are in. And it makes me feel very comfortable as a shareholder. So let's talk now about the valuation. We already looked at the free cash flow yield, very strong, almost 10%. So it does seem to be at a fairly low valuation. Price to earnings ratio on a non-GAAP basis being 13.6, fairly low. I won't go into why GAAP accounting has them at such an elevated valuation. It has something to do with their product mix and whatnot. I always focus on non-GAAP earnings, of which case a 13, almost 14 PE ratio is it's not crazy low, but it's pretty good. The price to sales ratio, again, we already calculated that was below 1. I think for a company like this, they do own the mining assets, have significant capital invested in that. We see that they are trading below book value of those investments, which I think is very, very positive. In other words, the money that you spend buying this stock today, you are getting your money's worth in terms of the assets that it owns. And then the price cash flow ratio, about 6, very strong. So I do think that the Seeking Alpha gives this a B plus valuation. I do believe that this company is at a tantalizing valuation. And furthermore, the dividend yield being where it's at, the dividend growth, it conceivably will be lower than 4-ish% because they saw that big bump due to more sales. Maybe it's 2-3%, making the chowder number not very attractive. However, again, if you're trying to hedge in your portfolio somewhat against inflation, then this stock appears to me to be a fairly low risk way to do that. So to that end, speaking of risk, let's talk about the risks. And I think the risks in this stock are somewhat complex, but definitely something that we should monitor. There's a couple obvious risks. You have the price fluctuations of fertilizer. That can significantly impact revenues, earnings, all that. So that's a obvious risk. You also have the price of natural gas being an input to the nitrogen fertilizer. If the price of natural gas were to spike a lot, that could harm earnings. However, when that happened last, the price of fertilizer outpaced the growth in natural gas, and it was not bearish for the stock. However, that does have an impact on the Morningstar said 20% of their profits they estimated coming from nitrogen, I believe. So that is susceptible to natural gas price fluctuations. However, um, North American natural gas being 75% of that input and being cheaper than European natural gas and other areas, that is a benefit, a net positive. So the main risk here, obviously, is commodity price fluctuations, specifically as it pertains to fertilizer profits, the main, component of their business. Another risk that we have is currency risk. So it's their production facilities are located in Canada, at least most of them. Um, so they're susceptible to currency risk, Canadian dollars versus US dollars versus other currencies. I would think that currency risks for this stock are probably more material than others. And I wanted to kind of verify that. This is a blog here. Um, we do see here currency fluctuations. Nutrien operates internationally, blah, blah, blah. In Q1 2023, 5% depreciation of the Canadian dollar against the US dollar impacted revenues by an estimated 300 million. That seems pretty significant, especially when you look at what's been going on with the Canadian dollar. This is the performance of the Canadian dollar versus the US dollar over the last year. Really has done poorly, especially in the last 3 months. It's really hit new lows. In fact, the Canadian dollar is basically at the COVID lows versus the US dollar. And we see here how Canadian dollar appreciation versus the US dollar may have benefited Nutrien's financial performance. Again, remember, this is the period of their outperformance right here, whereas the Canadian dollar is not looking great. It's basically at the lowest point that it's been, according to this chart, at or near the low. So I think that that's a fairly material risk, and something to monitor. However, for sophisticated investors out there, it is possible to hedge currency risks, and the company is hedging currency risks as well in the best that they can. So currency risks are very present. I think the next significant risk that we need to respect when it comes to this stock is the current geopolitical climate, the tariff risk. Um, Nutrien is located in Canada. Trump has vocalized his plan to introduce 25% tariffs against Canada and Mexico. And this isn't about what though this isn't about the virtuosity or if those are good or bad. This is about what that might do to this stock. Now, the United States is not a significant producer of potash, is not a significant producer of these fertilizers compared to countries like Canada. So the United States is a significant market for Nutrien. Um, in theory, even though the demand for fertilizers is somewhat inelastic and really just dependent on volumes of farm products, crops, all that, and demand of those, in theory, you have these big tariffs slapped on Canada. Well, we need to import this. I'm in the US, by the way. We need to import fertilizer to be able to farm. In theory, the United States agricultural producers will bear the cost of those tariffs. It does not mean that it does not mean that the company will not maintain its sales at the same clip it did before. However, conceivably that might lower demand somewhat, despite fertilizers being somewhat inelastic to demand. I don't know the exact elasticity of them, but in theory, in my mind, it makes sense that they're fairly inelastic. However, if again, the whole idea of tariffs is, oh, well, we're going to create potash now in America. We're going to create the nitrogen fertilizer and everything. We have to be able to do that. We have to be able to have the raw materials to do that in America. But I do see this stock having risk tied up in tariffs, especially if what Trump has said about the 25% tariffs on Canada taking effect. So does that necessarily mean that it will hurt sales? I'm not smart enough to figure that out. However, it is something to monitor. I think it also is something to monitor that tariffs are inflationary in a lot of ways, because prices go up. Again, this stock is priced, and the trading behavior of it does appear to fall along with CPI. Correlation is not causation. However, I think it's fair to say that this stock is an appropriate inflation hedge. However, tariff driven inflation may not produce the kind of outperformance here that we saw in the last inflation shock. The underlying cash flows of the stock are relatively safe. However, I do feel that there are real risks with this stock. It's a price taker, not a price maker. In a lot of ways, you have the strong currency risk, you have the tariff risk, and of course, execution risk, like any company has. But that's not even worth mentioning, I think. So those I see as the main risks there, and I think it is prudent to at least understand that if you are entering into a position on this stock, that you do understand those risks, or you're at least aware that just because inflation is going up, when it does go up next time, if it does stronger than it is now, that this stock price may not perform the way it did in the recent inflation shock, if that inflation shock is driven by tariffs. But I digress. What do I think about this stock? What is my grade? I think that even despite all those risks, the valuation is very tantalizing. I like its approach to shareholder returns, shareholder distribution. I like its size, scope, cost advantages. I think that it is a buy. However, it is not the type of investment that I think is appropriate to allocate a large percentage of one's portfolio to. I think it has an important role in smoothing out volatility across cycles. It does perform, and has performed rather, as a inflation hedge in the past in its short trading history. I do have strong reason to believe that it will do so even modestly in the future. So I believe that this stock is a buy. I have put a small percentage of my portfolio in this stock, because it checks a lot of boxes for me. However, it's not a big bet to make, at least in my opinion. So I do think, technically speaking, again, it's trading at a low. It's trading at one of the lower valuations ever that we've seen the stock trade at. Um, and why don't we actually just chart that? Let's chart the valuation. We have to look at gap, which we know that the price to earnings on a non-gap basis was low. I almost don't even want to rely on gap there, because I don't understand the why it's so different than the non-gap. So let's not put weight onto the price earnings ratio there. But just looking at the stock price, I think the valuation is tantalizing. The free cash flow yield is tantalizing. The dividend yield, all very strong. And the price, there is, I believe, a strong margin of safety at the current valuation. I think that there is a place in a portfolio for this stock, a portfolio that is looking to maximize risk adjusted returns over market cycles. So, yes, I graded a buy. It's not a strong buy. It's not a huge buy. It's not a buy with both hands. It's a buy, though, and for a small allocation. So, like I said, let's talk about risk parity. I'll keep this pretty brief. We see that it's demonstrated pretty inverse correlation to the index at large here. I think if you already have an allocation to US based large cap companies, whether you own the index directly through an ETF like VOO, something like that, SPY, if you have a strong allocation to the index as a whole, this stock is essentially giving you risk parity, and that's one of the main thesis. If you're entering into a trade like on this stock, onto NTR, into a position, you want to create some risk parity, then take the opposite side of that trade. And we're talking about large cap, wide moat, US base equity. I think that that's appropriate for risk parity, and it definitely would have been appropriate over the last 2 or so years. So, like I said, that was brief, but pretty straightforward, I think. So, let's take a look at the technical analysis. This is not going to be very complicated here. The only clear and definitive trend line really is this. And then to a lesser extent, it bounced off a level of support here. But if we look at this, it's just been trending down, lower highs, lower lows, just a bearish looking chart since the peak seen in Q1 2022. Just a really bearish looking chart. One thing I do want to note here, my trend line is very crude, but I think it's worth noting that this stock here may be on the verge of breaking out of this trend line. And I actually think that where it's at now is a very appropriate entry point, because again, while that may not be the lowest price seen, and theoretically it could keep going down, its prices are already cyclically low. We've seen that. We looked at this chart. Prices are cyclically low here. And in fact, they are higher than they were during this period, interestingly. So I think that the chart is worth monitoring. In other words, if this happens to break out above this trend line, even on weaker volume, but particularly on strong volume, I do believe that it could enter into a more sideways consolidation trade. Not necessarily go into an uptrend. Again, I think that it's highly correlated to fertilizer prices, and that will really drive a bull market in this stock price. However, technically speaking, I do find where it's at right now to be worth monitoring, because it is on the verge of breaking out. And if it does, I think that should give investors more confidence. However, the fact that I believe it's a buy right now, I'm somewhat agnostic to the fact if it breaks out or not. If it trades lower, then it might be worth picking up more shares. Again, I I have a small position in it. I believe I've probably already allocated enough for a full position, even though it's one of the smallest positions in my portfolio. Um, so technically speaking, very bearish looking chart. However, if it does break out above this downtrend resistance line, that's worth monitoring, because technically that will be pretty bullish. So that's going to do it for our video. Hopefully you found this very interesting. There's a lot more to cover with this stock that I didn't get into. I mean, it's already been almost an hour of me talking about this. I think that there's a lot to consider when taking a look at this investment, and there's a lot of risks. But I do believe that the current valuation creates a strong margin of safety, and that the dividend is safe and will continue to grow very modestly over time. So I really like it as a value based investment and a hedge against inflation, which may or may not come back like it did before. However, I think the market certainly views this as an inflation hedge. It's traded that way in the past. The financials, the underlying fundamental performance of the company was a hedge of inflation, and also there's the narratives driving that price. So I think it's a very interesting opportunity at the price it's at now, and definitely worth considering for investors who are looking to optimize the risk adjusted return of their portfolio. So that'll do it for today. Hope you found this helpful. I've certainly had a good time explaining my thoughts on it, and I'm open to your feedback. Please feel free to leave a comment. Make sure to follow me on Seeking Alpha, where I also, do write-ups of these stocks and place them there. Please consider, if you like my videos and my content, consider engaging with me, interacting with me. Love to hear from you, and giving me suggestions on companies to cover. So anyways, I look forward to, making more videos for you, and hope you found it entertaining and useful. And until next time, I will see you later. All right. Thank you. Have a good day.